You are 26 years old. You did everything the system asked of you. You got the STEM degree. You fought for the internship. You landed the corporate job in a glass building where the elevators play no music. Your base salary is $140,000. When your bonus hits in February, you hit $180,000. You look at the gross number on your screen and you feel a surge of pure, unadulterated arrival. You are in the top tier of earners for your age. You open a spreadsheet to calculate how quickly you can save for a down payment, how fast you can compound this in an index fund. Then you look at the net payout: federal income tax, state income tax, FICA, Medicare. Nearly 40% of the value you generated is gone before it ever reaches your checking account. You stare at the screen. You refresh the portal. The number doesn't change. You rationalize it the way everyone at your level rationalizes it. You tell yourself this is the cost of civilization. The roads, the schools, the infrastructure. You pay your share. You buy a house, you deduct the mortgage interest, you feel financially literate. You don't know yet that the government is playing a game designed specifically for you to lose. You work 60-hour weeks, you earn a promotion, your gross pay bumps to $220,000. You celebrate for one night. The next week, you realize the promotion just pushed your next dollar into a 32% marginal bracket. You are running on a treadmill that automatically increases its incline the faster you sprint. You are the engine. You are the liquidity that funds the state. The government takes its cut before you are even allowed to touch your own money. You are 30. You are at a dinner on a Thursday night. You sit across from a client. He owns a portfolio of regional car washes and a small commercial landscaping company. He tells you casually that his personal taxable income last year was exactly what yours is, $180,000. He arrived at the restaurant in a brand new $130,000 G-Wagon. You arrived in a 7-year-old Honda. You ask him politely how he justifies the car on that salary. He doesn't smile. He just says, Section 179. He explains that the vehicle weighs over 6,000 pounds. He uses it for his business. The tax code allowed him to count the full cost of the purchase as a business expense in the first year. His taxable income was legally wiped out. He drove the car off the lot and the government essentially subsidized 37% of it. That is the first fracture in your worldview. You realize in that restaurant that the system treats your labor as a fully taxable event and his capital as something to be protected. The government wants businesses to buy equipment, so it writes a rule. The business owner reads the rule. The middle class pays for the road the G-Wagon drives on. You stop trying to get a promotion at work. A promotion just means more taxes. You don't need a new title. You need a new tax character. You start a consulting agency on the side. You set up your business as an LLC and choose to be taxed as an S corporation. You understand how the system works and you pay yourself a reasonable salary as an employee. You take the rest of your profits as owner distributions. In one afternoon of paperwork, you legally bypass the 153% self-employment tax on more than half your income. It feels like a magic trick. It isn't. It's just page 1 of the architect's manual. You are 34. Your agency is scaling. You're making $400,000 a year. If you keep this in cash, the revenue ministry will ban you. You need a shield. You take your distributions and you buy a 16-unit apartment building in a secondary market. You discover the miracle of depreciation. In the real world, the property is appreciating by 6% a year. The neighborhood is growing, rents are going up, your cash flow is positive every single month. But on paper, on the tax returns you file, you tell the revenue ministry that the building is decaying. You hire an engineering firm to do a cost segregation study. You accelerate the depreciation of the roof, the appliances, the carpeting. You generate a massive 6-figure paper loss. You use that paper loss to wipe out the taxes on your active agency income. You are legally telling the government you are losing money while your net worth aggressively compounds. You sit at your desk on a Sunday morning. You look at your tax return. Your effective tax rate is lower than your assistant's. You don't feel guilty, you feel awake. You realize why the middle class is trapped. The middle class earns money, pays taxes on it, and tries to invest the leftovers. The wealthy invest money, generate paper losses, and use those losses to erase their taxes entirely. The middle class doesn't build the housing. The middle class doesn't capitalize the markets. The middle class just has a job. And because a job provides no structural leverage, they carry the tax burden for the entire economy. You are 45. Your net worth is $12 million. You own cash-flowing businesses and 3 commercial plazas. You want to buy a house in a ski town. The house costs $2.5 million. 10 years ago, you would have looked at your salary, calculated the 40% income tax, realized you needed to earn $4 million just to have the cash to buy the house, and given up. 5 years ago, you would have sold $3 million worth of your real estate, paid the 20% capital gains tax and the depreciation recapture, and bought the house. Today, you do neither. You understand the fundamental rule of the ultra-wealthy. Selling is an admission of defeat. Selling triggers the tax event. Selling kills the compounding machine. Instead, you pick up the phone. You call the private wealth division of a major bank. You pledge one of your commercial plazas as collateral. The bank underwrites a $25 million line of credit at 4.5% interest. The loan is not taxable income. It is debt. It is entirely tax-free. You buy the ski house in cash. The commercial plaza continues to compound at 8% a year, easily outpacing the 4.5% interest. The rental income pays the interest on the debt. You accessed millions of dollars in liquidity, you kept your original asset, and you paid exactly $0 to the revenue ministry. The middle class obsesses over getting out of debt. The wealthy use debt as an asset to remove themselves from the tax system. You are 68. You do not manage money anymore, you manage the structure. Your assets are held in irrevocable trusts. Your businesses are held in holding companies. Your net worth is an abstract number known to perhaps 3 accountants and 1 attorney. You have hundreds of millions of dollars in unrealized profit. The revenue ministry has been waiting 40 years for you to sell so they can finally take their 20%. You never give them dissatisfaction. You pass away quietly on a Tuesday in November. The government resets the value of your assets to what they are worth on the day you die. All of those deferred taxes, the millions of dollars in gains you built up over 4 decades, are legally, permanently erased. Somewhere in a glass tower in Midtown, a 24-year-old analyst opens his very first pay stub. He sees the gross number. He feels a surge of pride. Then he looks at the net. He sees the federal deductions, the state taxes, the FICA withholdings. He feels a pit in his stomach. He calculates the hours he worked against the money that actually hit his account. He thinks this is just the cost of starting out. He thinks eventually, if he just works a little harder, gets that next promotion, becomes MD by 35, he will outrun the math. He's wrong. The math is absolute. The middle class are the engine. They are the liquidity that funds the state. The government takes its cut before the middle class is even allowed to touch its own money.